So a firm's stakeholders have different motivations in evaluating its financial performance. Lenders want to determine creditworthiness, whereas potential investors want to evaluate investment potential. Still differently, management wants to set operational objectives, and employees want a good place to work. So you have all these different stakeholders that want or desire different things. So how do we kind of put all these things together? Well, the firm's accounting systems and external reporting will generate data, which is then used in creating insight into the firm's operations as well as their situation. Ratio analysis is going to be our primary tool that we're going to use to do this analysis. It's going to require financial data, and it will quickly help us evaluate the relationships between a variety of elements. Note that evaluating raw data is less effective and more tedious, so that's why we're going to do ratios. Financial analysis is light detective work, and there's a lot of room for creativity in analyzing a firm's results. However, note that this analysis is subject to some limitations. Past performance is usually assumed to be an indicator of future performance, but this is not always the case. Accounting standards can differ across firms in the same industry. Financial reporting is based on estimates that may vary widely, and data can be skewed by economic conditions. Acquiring financial analysis skills takes time, and you have to learn from experience that accounting data and ratios are only the tip of the iceberg when it comes to evaluating firm results. The data and ratios evaluated must be placed in the context of the firm's competitive and economic environment. All right, so now turning to 6.2, one learning objective is calculating accounts receivable turnover to help assess a firm's performance in managing customer receivables. So the relationship between credit sales and accounts receivable reflects how quickly a firm collects its receivables. So we're going to look at the net credit sales, and we divide that by the average accounts receivable. And note that the average accounts receivable is typically going to be found by comparing the last two periods in which we have data concerning those accounts receivable. So net credit sales divided by average accounts receivable will give us accounts receivable turnover. The decision on the credit terms that we extend will have a significant impact on cash flow. If we extend credit, then we're not going to get paid as quickly. Or if we don't extend credit and require cash payments, we'll get cash relatively quickly. But, if we shorten credit terms, we could lose customers. And then if we extend credit terms, we may have bad debts as a result that we're unable to collect. So keep both of those things in mind. Some other ratios we want to consider include, from an operating efficiency standpoint, include total asset and inventory turnover ratio, as well as day sales and inventory. All of these are measuring efficiency in managing assets. The one here you see on the screen, this pertains to your accounts receivable or your credit sales. When we look at the total asset turnover ratio, efficient firms want to generate a higher sales per dollar of their assets. If you don't do that, then you're classified as inefficient. So total asset turnover is defined as net sales divided by average total assets, and typically the higher the number, the better. And then looking at inventory turnover, this is your COGS, or cost of goods sold, divided by average inventory. Note that typically some things with this, especially when we talk about inventory, it's kind of a balancing act, because if you have lower inventory, you may lose sales because you can't meet the demand. And then inventory management note is also a balancing act between sales and cash flow impacts. Turning to day sales and inventory, this is going to be ending inventory divided by cost of goods sold. And we then take that number and multiply by 365. You can also get the same result if you take the inventory turnover that we calculated in the previous slide and divide it by 365. Typically, lower days of inventory is going to be generally preferred unless lower inventory levels result in stockout situations where you run out of inventory and then thus lose sales because you cannot meet the demand. Next, we're going to turn to liquidity ratios. And liquidity relates to the ease with which a firm can generate cash. The two ratios employed in this particular section are the current ratio and the quick ratio. The current ratio that you see on the screen here is current assets divided by current liabilities. Can you think of an example of a current asset? What about a current liability? So current means that it's going to happen in the day-to-day operations of the firm, and it's going to convert over to cash or be paid out as cash within the next year. Okay. So some examples of current assets would include cash, accounts receivable, inventory, marketable securities. Examples of current liabilities would include things like accruals, payables, like a notes payable, wages payable, accounts payable, what you owe your suppliers. Okay. Note that the assumption here with this ratio is that the only source of cash to settle liabilities will come from liquidating current assets. That may or may not be the case, but that's kind of the assumption with this ratio. Another ratio we can look at is the quick ratio. It's a little bit narrower because it excludes current assets that are not readily convertible into cash, such as inventory and prepaid expenses. This compares only the most liquid assets to the firm's current liabilities. The cash ratio only looks at cash and cash equivalents, such as marketable securities, to satisfy current liabilities. Note that the higher the ratios, the less risk there is that a firm will not meet its current liability obligations when they become due. However, we don't want this number to be way too high because if it is, that would suggest that the company might have too much cash and they're not deploying it well enough. Example of this in the past have include Facebook or Meta, as well as Apple. And Apple actually at one point in the mid 2010s had so much cash that the shareholders noticed this and requested that they pay them a dividend because at that particular time, Apple actually had more cash than the federal government had on hand in one particular instance. So shareholders requested a special cash dividend to since if Apple wasn't going to take the money to invest it, why not give it to the shareholders? And that's exactly what wound up happening. So note that more liquidity is preferred over less liquidity. Higher current ratios, quick ratios, and cash ratios are preferred to lower ones. And this is a somewhat oversimplified view of how cash management works. It's a lot more nuanced than this, but this is, at the introductory level for you all, this is fine. Solvency ratios. So what is solvency? Well, solvency refers to the ability of a firm to shoulder debt. This is often confused with liquidity, but note that these two things are separate concepts. The debt to assets and debt to equity ratios compare the level of debt employed by a company to its assets and to its equity. Also, a lot of times like to say that solvency pertains to it's a longer term view of the company. So your debt to assets ratio is one ratio we can compute to do this, and this is going to be your total debt to total assets. And what this is going to answer the question, or attempt to answer the question, how much of a firm's assets are financed with debt or liabilities? Okay. The other way to do this is using the debt to equity ratio, which takes the total liabilities and divides it by total stockholders' equity. And then asks the question, what is the ratio of liabilities or outside funding to the investment of the owners? And then is there too much debt employed by this firm or is there too little debt? Note that there's not some optimal ratio with regards to these two things in terms of how much debt you should or should not have. It's kind of a preference in terms of the companies. But typically, what I like to say is that when we're talking about debt to assets, if that number is greater than 50%, that kind of gives me pause. That's not just looking at one statistic, but I would want to investigate the story behind what are they trying to do with that. And then if that's the case, particularly here with 50%, if I see a debt to equity ratio that's greater than one, that gives me a little bit of pause concern that the company might have too much debt, maybe. But again, depends on what their strategy is, depends on the industry, et cetera, et cetera. So note that both statistics are useful in evaluating a firm's capital structure, meaning the debt to equity mix or the amount of debt it should employ. In general, capital-intensive industries will tend to employ higher levels of debt than service businesses, which don't require much capital investment. By comparing the firm's earnings before interest and taxes to its interest expense, you can determine how much of a cushion a firm has in covering its interest expense, and lenders and the debt rating agencies will use these ratios in determining your credit worthiness. Okay, so now turning, let's say if there's one other additional ratio to consider is the TIE, or the times interest earned ratio. This is going to take EBIT, or earnings before interest and taxes, and it divides it by the interest expense. We want this cushion to be pretty high. This is also kind of a measure of risk, so to speak. So there's less risk that the firm will not be able to pay its um, interest expense if this number is too low. Okay. Section 6.5, we now turn to market value ratio. So the first one you see here is earnings per share. This takes the difference between net income and preferred dividends and divides it by the weighted average common shares outstanding. Okay, so this tells us how much a firm generates in profit for each outstanding share of common stock. And while we can track how earnings per share has changed over time for a firm, comparing earnings per share across firms isn't meaningful because they have differing numbers of shares outstanding. Generally, shareholders really like high earnings per share, but it's complicated in terms of the calculation, how things change over time. From an investment perspective, a lot of investors really like this price to earnings ratio, the market value per share over the earnings per share. And this particular one basically tells you for every dollar of earnings that your company has, how much am I paying for it? So for example, a PE ratio of 15 would mean that for every dollar that a company is earning, you're paying $15 for that. So the price to book ratio is the difference between total equity and preferred equity divided by the total shares outstanding. These can be meaningful. These ratios are meaningful, but note some caution here. Book value and market value are not related to each other. They're calculated in two totally different ways. The book value is accounting, market value is economically and financially driven because it's a result of the price of the supply and demand of shares in the market. So basically, at what price is a willing seller going to sell shares to a willing buyer? And that fluctuates every day, every weekday, business day when the markets are open. And then lastly, 6.6, we talk about profitability ratios and the DuPont method. So profit margin is going to take information from your income statement. At the very bottom, we have net income. At the very top, we have sales. We divide those two things together to get us profit margin, or excuse me, net sales. Okay, so net income over net sales, profit margin. The higher, the better. Okay, this tells us how much of each dollar of sales converts to net profit. The profitability ratios also encompass our return ratio. So return on total assets is a measure of the firm's efficiency in employing its assets and generating return. Return on equity is a measure of a firm's ability to employ its equity while also generating return. So return on total assets is the net income divided by the average total assets. Note again, average, that's just taking into account the total asset data that you have from your last period to one prior period. And the same as average voters' equity averaged with the previous period. So basically the last period plus the period before divided by 2, that's your average, okay? And then we take that number, that's the bottom part of the fraction. So then we'd have net income divided by whatever that average is for those total assets for return on total assets and stockholder equity for the return on equity, respectively. Again, these ratios are very dependent on accounting data that can be easily manipulated. And yours truly, especially from a finance perspective, I would say it's best to rely on cash returns rather than accounting returns. Lastly, what we can do is something called the DuPont method, and it kind of shows how all these things are related. Okay, so the return on equity, ROE, is equal to the profit margin, that profitability ratio, multiplied by the total asset turnover, or an asset management ratio, multiplied by the equity multiplier, which is another measure of how much debt that your company is using, or the leverage of it. Okay, so we take our profitability, multiplied by asset management, multiplied by what's going on with your capital structure, and that will give you return on equity. So this one ratio, by breaking down the return on equity into these 3 components, This can help you create strategies for improving the results for the separate components. Now, I will note that yours truly, I would not recommend that you just lever up your company, meaning that you take out more and more debt just to maximize ROE. I don't think that's a good long-term play, but some companies will do that. I think it would be best for you to focus on generating profit from your sales as well as also generating sales from your assets. And looking at those things, but note that equity multiplier, that is a leverage factor that will amplify the return on equity. But note with leverage, it amplifies profits in good times, but it can also amplify losses in bad times. So word of caution there if you decide to pursue that strategy. So thanks for watching this presentation on Chapter 6 concerning measures of financial health, and I hope to see you in the next one. Take care.